Welcome to the overview of the end of chapter problem for chapter number 5, problem number 1. The first thing that I want to point out is that in the eCollege material, there's some pretty good instructions regarding problem number 1, part A, B, and E. Notice for part A, it tells us specifically to use the percentage of sales method only for the following accounts. So on the income statement, we want to use the percentage of sales method to project the cost of sales, as well as sales general and administrative expenses. On the balance sheet, we want to use accounts receivable, inventory, accounts payable, and accrued expenses. We want to use the percentage of sales method to project those items. All of the other items on the income statement should be either calculated or we're going to use the exact amount from the previous year. Speaking of which, it also tells us that to use the same amounts from 2010 to project the following 2011 account balances. So on the income statement, notice there's other non-operating expenses. We're going to use the same amount for 2011 or in projecting 2011 as was the previous year. And then on the balance sheet, there's quite a list that we're going to copy from the previous year. So once again, in this particular section, we know that some certain accounts maintain that relationship with sales, but in other cases, it does not maintain that relationship. So we're not going to try to use a percentage of sales method in those examples. Note also it talks a little bit about the dividend payout ratio and how to calculate the common dividends. Okay, clicking back onto the spreadsheet here, first thing that we want to do is insert a cell, insert a row, and then go ahead and narrow that down. Remember that Excel is very good at memorizing or recognizing a sequence of information. So if we just highlight the previous years and then copy that over to the current year, it's going to show up as June 2011, 10, 9, 8, so on and so forth. Starting out, the problem tells us that the projected sales for 2011 is going to be 81,000. Okay, let's go ahead and copy our formatting. Use the Format Painter. And there we have it. Next, let's go ahead and copy the years. Right-click and copy and paste. And we're going to use these columns as a helper column for calculating the percentage of sales. We know that cost of goods sold has that relationship with sales. So let's do our calculation. Say equals cost of goods sold for 2010 divided by the total revenue for 2010. And once again, let's use our referencing. Use the F4 key, click on it 2 times, and hit return. Change that to a percent, maybe to 1 decimal point, and copy it over. Okay, now then, use the average function and calculate the average for that 5-year period of time. Hit return 2 times, and now go back in and multiply by the total amount of revenue, and hit return. And so our projected cost of goods sold is $39,905. Now let's go back to our eCompanion and note that it's telling us that we want to use that percentage of sales method to calculate or to project the cost of sales and SG&A expense. And then on the income statement, we're going to, for other non-operating expenses and total extraordinary items, we're going to use the same amount as the previous year. So clicking back onto the income statement, it's telling us the selling, general, and administrative expenses. We want to use the same methodology to calculate the selling, general, and administrative expense. Note for the interest expense is going to be a factor of the amount of debt and the interest rate. Notice in the problem on page 165 it's telling us that in part B the interest rate should be 4.5%. So that's the rate that we're going to use in calculating the interest expense. Note that the interest expense is going to be 4.5%, and in this case let's use notes payable, the current portion of long-term debt, and long-term debt. Calculate the interest expense, the 4.5% of the projected items for those three accounts. Okay, now the problem is telling us, if we go back to our e-companion or e-college, it's telling us other non-operating expenses. So if I go back to the income statement, other non-operating expenses simply going to be equal to the previous year information. Income before, total extraordinary items is going to be the same amount as the previous year. And then everything else is simply calculated. Notice that the preferred dividend, let's go ahead, and the problem tells us is going to be equal to the amount from the previous year. So preferred dividend is not going to change. The income available to common stock, notice that there's a formula here. However, you'll just be able to copy that formula over. When it comes to the gross dividends, and you will need this, the gross dividends to common stock, the problem tells us that the dividend payout ratio is 42%. So whatever you end up with for income available to common stockholders multiplied by 42% is going to be equal to the amount of the common stock dividend. Now, clicking on to the balance sheet. Okay, it's a pretty extensive balance sheet here, but once again remembering from our e-companion material, if you click back to it, it says to use the percentage of sales for accounts receivable, inventory, accounts payable, and accrued expenses. So accounts receivable and inventory, accounts payable and accrued expenses. We're going to use the percentage of the percentage of sales method to calculate or to project these four items, and then going back to the e-college, the rest of these balance sheet items we're going to simply use the previous year's total. And let me go ahead and insert a column, and I guess I can copy that over. So take, for example, the first one is cash, short-term investments, prepaid expenses. So equals the previous year. Same thing, equals the previous year. Okay, prepaid expenses equals the previous year. That easy to do. Copy your formula across. Other current assets, I believe that's equal to the same amount from the previous year as well. Okay, and once again, use your Format Painter to Format Painter, move it over, boom. There we have it. One more final tidbit of advice here is that down here in retained earnings, you will need to be able to calculate retained earnings. Just once again, kind of a review. To calculate retained earnings is equal to the previous year's retained earnings plus the projected net income minus the preferred dividends minus the common dividends. That will be equal to the projected retained earnings. This isn't the correct amount, though, because of course our income statement is incomplete and we don't have everything that we need. But that's the way that you're going, or how you're going to calculate the retained earnings. Now finally, in Part E, notice that Part E has a best case, base case, and worst case scenario. The way to work, once you're done with your first projection and you're able to get the discretionary financing worked out, what you want to do is go File, Save As, and call that, and notice this is whatever it happens to be, but call it base case. Base case scenario, okay? And then save. And then your base case scenario, whatever you have for your discretionary financing, is your base case scenario. Then go into the file, save as, and change this to the best case scenario. Now notice with the best case scenario, it tells you that sales are expected to be 5% higher. Well, if notice that we're projecting 81,000, best case scenario is telling us that the 81,000 times 1.05 or 105%. So the best case scenario is that Procter & Gamble might have $85,050,000, okay? And then you would just go back and rework the discretionary financing. Now, once again, kind of referring to our eCompanion, it does give us a little guideline. It's saying do not use Excel's scenario manager function when trying to do the scenarios, because this is an iterative worksheet, and the worksheet will not, or the scenario manager will not work the way that I've shown you how to put together this problem. So we've worked around some of the complicated features in this particular problem, but now the scenario manager won't work, so we just have to do it on a manual basis. After you change the total revenue to 105%, rework the discretionary financing, click on save, and then say file, save as, and then change it to worst case scenario. Worst case scenario, save, and then notice the worst case scenario is that sales are 95%. So if we multiply that by 0.95 and hit return, then just click on to the balance sheet, rework the long-term debt to identify the discretionary financing and put it together in that way. That's the best way, easiest way that I've found to work through best, base, and worst case scenarios in this iterative type of process here. I hope that helps you to get a good start, and we'll see you again in chapter number 6.